Good morning on this beautiful sunny day in Philadelphia. I hope you are doing well today. My name is Erin Ellis, and I will be leading the webinar today. We'll give it 1 or 2 minutes to get started, but in the meantime, take care of some housekeeping things first. So you will see on your dashboard on GoToWebinar, I have 2 handouts available for you. And the first handout is a resource guide that I created, and I'm going to be referencing the resource guide throughout the session today. So we will look at it towards the end, but it's going to have links and some really helpful information in terms of where to go for more information and some tools that you might find useful. So that is that first handout that is on the handout panel. The second document is a copy of the PowerPoint. So you have it already. Both of these documents will not be emailed out afterwards. So if you want to save them, open them up now and save them or take a look at them here. So everyone today is in listen only mode. If you have a question or need to otherwise communicate with me, you can do that through the question portion of the control panel. So if you want to give us any feedback, then just type into the question box and we can see that throughout the webinar. So I'm here today. My name is Erin Ellis and I'm a financial educator at the Philadelphia Federal Credit Union. And I do have 2 of my colleagues helping out today. Pablo Soto will be answering some mortgage questions. He is a certified mortgage specialist. If I get the title wrong, please excuse me. And Shannon is another one of my colleagues who will be here if you do have questions with accessing handouts and things like that. So great. So that's that. So check out the handouts and communicate through the question box if you do have questions. We will leave time for questions at the end. Feel free to drop them in the question box throughout, but know that towards the end of the session today, we will have time for questions. So today's session is from 10 to 11:30. So we'll save the last 15 minutes or so for questions. And again, grab those handouts now if you want them. All right, so while we're sort of rolling in, I'm just gonna launch a quick poll. I'm curious, is this your first time attending a PFCU webinar? So just a simple yes or no. So you should have a poll popping up and you can just take a quick yes, this is your first time attending, or no, you've been here before. A couple more seconds for that poll. All right. Great, so a lot of new folks today. Welcome. For those of you who have been here before, welcome back. Glad to have you again. So, okay, great. I really appreciate that feedback. So we will just get rolling. 10:03, I know some folks will be joining us, but we'll get started right now. All right, so a little about PFCU. Many of you are probably members of PFCU, Philadelphia Federal Credit Union. Just a little about us for those of you, whether you're a member or not. We are not a bank. So credit unions are different because we are actually owned by our members, which means that we don't charge the same amount of fees associated with commercial banking. We're generally much less expensive than those commercial banks. And the profits that we make are returned to our members in lower fees and better rates. And so, today we're talking about mortgages. It's a great idea to take a look at PFCU, take a look at credit unions when it comes to mortgages because of the lower rates and lower fees that credit unions tend to have. So it's a great place to shop around. Oh, one other quick plug right now. For the month of April, we are doing a promotion that if you refer another member if you refer someone to PFCU, you can get $100 as our member referral credit right now, rather than the usual 25. So refer your friends. If you want, you can always email me. My email is on the handout, and also I will share it at the end. Okay, so today, this is basically, you should be able to see, we have 3 pieces to the home ownership puzzle, and today we're going to focus on parts 2 and 3. So we're looking at, if you're going to buy a home, you really need these 3 are the big pieces. So 1, steady and reliable income, 2, good credit, and we're going to define what that means, and 3, money, right? So down payment, closing costs, and we'll talk through a lot of that today. So we're going to focus on 2 and 3 because these 2 pieces too will change the amount you pay monthly and overall. So good credit can change the amount you pay a lot, and so we'll be talking about that. The money you put in as a down payment will change the amount you pay a lot too. So these are really big factors that we want to not only think about to be prepared, but also think about the way they impact our bottom line, which is our payment. So you want to avoid accumulating additional debt once you have that mortgage payment. So there are so many moving pieces to this, and we're going to look at how these pieces relate to each other and how we can manipulate them to achieve what our goal is, which is home ownership. So that's the plan today. So a little about where I get my information and about where I get the tools. And this is just a general recommendation. Not only is it where I've got some of the tools that we're going to look at today, it's also a place that I recommend that you go to for questions about money, personal finance concerns, tips, tools, all that good stuff. So I really love the tools that the Consumer Financial Protection Bureau has, and we're going to sort of follow their guideline for buying a house. So their website is there, and you're going to see a link in the handouts to a bunch of tools that I really like that are created by the CFPB, and they're really great because you can input your own information and sort of figure out what's going to work best for you. So big fan of the CFPB, founded by Elizabeth Warren, but just a little plug there. Okay, so we're thinking about, are you ready to buy? So I'm going to launch another poll here. And so this is sort of a little checklist. And this checklist is not exhaustive. It's not everything. But when you're thinking about, are you ready to buy? So take a look at the poll that popped up, and you can select as many as you want here. But do you have, now you're here not to be discouraged, right? You're here because you're planning. And research shows that people who plan carefully for big purchases, like a home, are much less likely to have financial trouble later. So the idea that you're here because you're doing this right is awesome. So you shouldn't have all these things already right now, right? We're here to plan. Okay, so thinking about, do you have at least 2 years regular steady income? Is your income reliable? Do you have good credit? And when I say good credit, in this case, we're looking at over 700. Do you have a few long-term debts like car payments, student loans maybe, but not a lot of other debt like credit card debt? Have you saved money for a down payment? Can you pay for a mortgage every month? Can you pay other costs like insurance and taxes? Can you set aside money for other costs of home ownership like closing costs, moving costs, new furniture and home improvements? And can you also save for emergencies? So take a look at this, check all the ones that you're ready, right? That you can do currently, and answer that. All right, so a couple more seconds for this poll. All right, 2 more seconds. All right, 3, 2, 1. Closing the poll. Okay, great. Still voting. All right, so I'll share the results with you so we can look at what does the audience here today look like? And, frankly, this makes a lot of sense. And these results look good because what we're looking at today is folks who, a lot of you have, yeah, I can pay. I do have that income. I can pay the mortgage every month. What I want to work on is maybe a little on credit, maybe a little on savings. And so we're going to focus on those two pieces of the puzzle today and really sort of flesh out some of those things. Okay, so great. So that's great. And again, you're here to prepare. So congratulations, you're doing great just for being here. You're in a better position for the future. Okay, so this is the objective for the day. We're going to examine various parts of a mortgage and use that knowledge to decide what realistic and affordable means for you. So what does it mean for you? We're looking at, what's important to you. Is it a bigger home with a larger mortgage or more financial flexibility? You are the only person who can decide what's affordable. It has nothing to do with what you're approved for. What's affordable to you is going to be dependent on what you decide. And so that's what we're looking at today. And the idea is you figure out what works for you and then shop around until you find it. Some of this conversation today will be hard to hear because, houses are expensive. And in particular, right now, the housing market is not for people buying a house. Houses are very expensive right now. So it's a great time to prepare. We want to be thinking about too, what does our mortgage payment mean for other financial goals that we have? How's it going to impact the ability to retire or save for, college, things like that. So we're going to look at how do we find the best fit for you. All right, so here's how we're going to do that. We're going to look at some key terms using an example mortgage. So we're doing this because I find a lot of times people know how to pay bills, people understand their own finances, but we don't always have the exact financial language to use. And so we're going to learn and sort of discuss the financial language today. And we're going to really break down these two pieces, the credit piece and the money piece. And then I will share some resources, and Pablo and I will answer some questions at the end. Okay, so this is where we're going to talk through some of these terms so we're all on the same page, and we're going to use an example. And so I used an example of a home that cost $200,000. Now keep in mind the median home price in Philadelphia is $220,000. Okay, we're going to use the income here of about $55,000, $50,000 to $55,000 for a household when we're sort of running through some of these numbers. So let's look at this $200,000 house, which is, again, just a little lower than the median. Although, if you ask me, still quite an expensive house, right? And let's look at what this might look like. So we're looking at, with this house, this scenario, we've got a down payment. A down payment is the amount you pay toward the home up front. Generally, the larger the down payment you make, the lower interest rate you will receive, and the more likely you are to be approved for a loan. So this is important, and we're going to look a little deeper at that down payment, right? But the bigger the down payment, the lower the interest rate you get. The bigger the down payment, the more likely you're approved for a loan. So this down payment is a really important piece of this puzzle. You need a down payment of at least 3% of your target home price. Many loan types and lenders require 5% down. So in this case, we're using 5% down of this $200,000 house, and it's $10,000. You can often save more if you put down at least 10% on a home, and you save the most if you put down 20%. Now that might not be realistic, so there are options, but it's good to know, if you're putting down 10, you're going to save. If you put down 20%, you're going to save even more. All right. So now the next thing we'll look at is the principal, the next term. So the principal is the amount of the mortgage that you have to pay back. Your monthly payment includes a portion of this principal. So in this case, my down payment, I paid out $10,000. I'm going to borrow. My principal is $190,000. The interest rate. The interest rate on the mortgage is the cost that you pay each year to borrow the money. And that's expressed as a percentage. So it's the additional money you pay. I'm going to pay back that principal. I'm going to pay interest on top of that. It doesn't reflect any fees or any other charges. It's just additional money, not including those extra fees. And then the term. So the term of the mortgage is how long you have to repay the loan. Most types of home mortgage is 15, 20, or 30 years. And most commonly people have 30-year mortgages. So using this example of this $200,000 house with an interest rate of 3.5%, which is about the normal right now. I'll say, I don't know. I don't want to say average because I'm not sure it's exactly average, but about a typical rate right now, we'll say, is 3.5%. In total, that home is costing me the principal and the interest. So it's costing me $307,000. Okay, so I'm paying back that $200,000 for the whole home. I'm also paying an additional $117,000 in interest. Okay, so we see that huge interest payment, and we're talking about how can we lower that? Well, changes to your down payment and changes in your credit can impact that. So we'll look at those in more detail. All right, so that's sort of looking at the total cost. Now we're going to look at the monthly cost. And so when we're looking at your whole home payment, it is the principal and the interest, but there are other things you pay monthly too. And let's just look through these pretty quickly. I want to remind you, I'm going to continue to remind you again, several times today, only you can decide what you can afford. You might be approved for something, but it is not what your family can afford. And I will speak from my own experience. Based on our family income, we could have been approved for more, and we never could have paid it. We're going to look at our monthly expenses too. And so it's something to keep in mind. What can you afford, not what are you approved for? So let's look at sort of estimating what the total monthly home payment will be. We're going to add up all of this below. So we're going to look at your principal and your interest, right? That we know right off the bat, what are we borrowing and what are we paying in interest? So in this case, I'm paying in month one only $299 towards the principal. So the first month, $554 of my payment is towards interest. Many principal and interest calculators are available online, so you can see what it's going to look like and predict. And these calculators, these mortgage calculators, are incredibly useful when you're figuring out your own numbers. All right. Next, we're going to see mortgage insurance or private mortgage insurance or PMI. You're going to see that sort of referred to as that. And this is something I had no idea existed until I bought a house. And I did not even know it existed until I was at closing. So you're already ahead of the game. Mortgage insurance protects the lender if you fall behind. And most times it is required if your down payment is less than 20%. So if we're looking at the down payment of anything less than 20%, you're going to pay mortgage insurance, PMI, every month, most times. It's typically required on any FHA or USDA loans. And the typical cost for mortgage insurance is between 0.5% to 1.8% of the house cost, right? So in this case, I just took the middle. Right. Now we've got property taxes. And of course, you can look at the city and figure out based on the value of the property, The property taxes are often collected with the mortgage payment, and they're paid to the city once a year. And this is called an escrow account. If the loan doesn't have an escrow account, then the homeowner will pay the property taxes directly. So we've got property taxes and insurance, and we're going to wrap those into an escrow account. So I'll tell you a little about that. So escrow is an account set up by your mortgage lender to pay certain property related expenses like property taxes and homeowners insurance. So every month, a portion of my payment goes into that account. So I'm paying the principal and the interest. I'm paying an additional $200 for that PMI. I'm paying $180 a month for my property taxes, $78 a month for my homeowners insurance. And my total monthly payment then is $1,300 approximately. Okay, so the homeowners insurance pays for losses and damages to my property if something unexpected happens, like a fire or burglary. When you have a mortgage, most lenders want to make sure your property is protected by insurance. They generally require proof that you have homeowners insurance. So mortgage insurance, or PMI, is different than homeowners insurance. Homeowners protects you, PMI protects the lender. So we're going to look at this total monthly cost that you have. And that is your monthly home payment. So a mortgage lending rule, general guideline is that your total monthly payment should be at or below 28% of your monthly income before taxes. So that's a general rule. It doesn't always work for everyone, but we're looking at 28% of your monthly income before taxes, which is your gross. Lenders may approve you for more or less depending on your overall financial picture. But again, I'll say, you know, what you're approved for doesn't necessarily mean it's right for you. And usually if you do put that 20% down, you don't have to pay private mortgage insurance. All right. Okay, so that was a lot. We're gonna have a quick check-in because that was a lot. So here's the question, and just take your best guess. A larger down payment usually leads to what? Does it lead to a lower interest rate, a higher interest rate, or has no impact? And if you know we're not quite there yet, we're going to get some more information. So the larger down payment, what is its impact on your interest? All right, we're going to do this one quick, just a few more seconds. All right, 2 more seconds. Okay. So the answer is that a larger down payment usually does lead to a lower interest rate. Okay. Great, and most of you got that. So wonderful. All right, let's move on to credit. Okay. So credit and understanding your credit. So we have the context, right? We've got this sort of vocabulary out of the way and an example to work from. We're going to look at credit next. So here's the bad news up front. If your credit score is below 700, you will likely pay more for your mortgage. That's the bottom line, okay? If you work on improving your credit and wait to buy a home, you will likely save money. Some people who improve their credit save $50 to $100 on a typical monthly mortgage payment. Now, think about $100 times 12 months. That's $1,200 times 30 years. So that's a huge amount of money. It might feel like a small amount when you look from month to month, but if you look at the whole loan, it can save you a tremendous amount of money if you make sure that your credit is in good shape before. That you want to correct any errors on your credit report that may arise. This can raise your score if you correct these errors, and it's a good idea to correct any errors before you apply for a mortgage. So we'll talk a little about it today, but I'm also going to give you information in your handout about how to do this. Additionally, in that handout, there's a link to one of my credit webinars that I did so that you can take a look at how to manage that debt, how to pay down your debt, how to improve your credit. I will also be doing a webinar on improving your credit score next month. So check in what's going on in May on our website because you might find that to be really useful. All right. So we're looking at your credit impacting your interest rate, impacting your homeowner's insurance premium. Your credit impacts the amount you borrow, and it can impact the cost of your mortgage insurance. So it has so many different ways that it can impact your costs. So this is a little example, and this is from the CFPB, the Consumer Financial Protection Bureau. They've got a really good tool to show you sort of based on the interest rate, you can adjust how much you put as a down payment, how much your home price is, and what the difference will cost you. So you can see on this slide, I have two different interest rates. One is 3.125, the other one is 4.5%. And so the same $200,000 house with the same down payment of $10,000, we're looking at the interest rates. The first 5 years, $28,000 for that 3.1%. We're looking at $40,000 in interest for the 4.5%. Over the life of the loan, you can see, it's above, it's $53,000 more that 4.5 interest rate costs, right? So that's a ton of money, just a tremendous amount of money. I see a couple of questions about PMI in the chat that I can answer. Does the PMI go away if you have 20% of your principal paid? It depends on the type of loan. So some loans carry PMI for the life of the loan, but other loans, the PMI will go away once you reach that 20%. So it's a good question, but I'm going to leave that there for now. Okay. All right, so what do we do about our credit? There are three major credit bureaus: Equifax, Experian, and TransUnion. And those three credit bureaus report all of our credit data. And lenders use your credit scores and the information on your credit report to determine whether you qualify for a loan, number one, and then what interest rate to offer you. So you're going to want to, and now is a great time to do this, get copies of your credit report. Check your reports carefully for errors. Look on your credit reports for any debts, credit cards that you don't recognize. And also on your handout, there's a link to a credit report checklist, and it will walk you through how to review each report and what to do. So you're looking for finding errors and filing disputes as soon as possible. So this is a sort of one of the first steps in the planning process for a mortgage, is to get this ready now. And now is a great time, because if you get this ready ahead of time, even if you're not ready to buy a house, you have time for these changes to take place, right? You have time for these errors to be corrected. And you can get your credit report from all three credit bureaus once a week. And checking your own credit has no impact on your credit scores. It used to be monthly, but currently we can get once a week, we can get those credit reports. And that has changed due to COVID. Because identity theft and fraud has increased, and so now we're given more access to our credit reports. Right, so let's look at credit scores for a second. All right, so your credit score is only one factor in the mortgage lender's decision, but it's an important one. There are options for getting your credit score. One option is that sometimes your credit card or your loan statement will include a credit score. Another option is that you can see a certified housing counselor, because most of the time, your credit score, most mortgage lenders use FICO scores, but FICO scores are not generally free. So another link, you can learn more about your FICO score and where to get it, but check your statements on your credit cards or loans if you have them to see they might include a FICO score. Otherwise, I really recommend seeing a certified housing counselor, and I'm gonna say that several times today, and I'm gonna give you a resource for that, and I'm gonna recommend Clarify as a way to sort of check your credit and check in, and I'll give you a little more detail about that in a minute. But what to know about your credit and your credit score. Checking your own credit will not hurt your scores. Credit scores range from 300 to 850. The higher score represents a better credit history and makes you eligible for lower interest rates, right? That's what we're chasing here, the lower rate, because it costs less money. Most mortgage lenders look at FICO scores from all three of the companies and use the middle score when they decide what rate to offer you. So we'll take all three and use the middle one. If you're applying for a mortgage with a joint owner or with a co-borrower, and I found this really interesting, I didn't know this. If you're applying for a mortgage with a co-borrower, lenders look at both the middle scores and use the lower one to decide the rate and approve the loan. So if it's you and your partner, they're going to use the lower of the two of you to decide the rate, which is interesting and something to sort of keep in mind. The rate can offer quite a bit depending on your credit score, that interest rate. And there are no firm rules about exactly how your credit score affects the interest rate, but in general, here's what we're going to look at. And I have this sort of broken down. And again, this is coming from the Consumer Financial Protection Bureau. The best rates go to borrowers with credit scores in the mid to high 700s or above. So that's sort of the goal, right? That's the big goal is middle 700s, high 700s. These borrowers also have the most choices available to them. Choices are good. Borrowers with credit scores in the high 600s to low 700s, they're going to pay somewhat higher rates. Borrowers with credit scores in the low to mid 600s generally pay the highest rates and have the fewest choices. Borrowers in this range may have trouble qualifying for a loan depending on the loan type and the specific lender. So if your score is lower, you might be locked into one of those FHA loans, and the FHA loan then comes with that PMI or the mortgage insurance for the life of the loan. So right off the bat, you're looking at an increased cost unless you refinance. And if none of that made sense to you, just know that the higher your score is, the more options you have. And in general, you know, below 600, you're going to want to improve your credit. And I only have like that little bit of laughter in my voice because the CFPB is like, first, work on your credit. Because it's not going to be a positive situation until you get your score up a little bit, right? You're going to get yourself in trouble if that option is available. Okay, and if you need help getting your score, because there are educational scoring models out there, FICO is the one that most lenders use, but FICO is not always free. It can be very expensive. And so a link on your handout to a resource about where can I get my credit score, and so you'll find that. But here is a place to get a credit score. So you can check for errors on your report, dispute any of these. If you need help with building credit, paying down debt, getting free credit counseling. So I'm going to recommend, and I recommend you'll hear me talk about Clarify several times today, but Clarify is a local nonprofit. They are a partner of PFCU, and they offer free credit counseling. They offer a variety of financial counseling, in fact. They are a nonprofit, and that's significant because they are not in business to make money off of you. They are in business to help people. So they are a great resource to sort of talk through your credit report with and look at some strategies and ways to improve it. they can help you with that. They can also help you find access to your score. So Clarify is an outstanding resource. It is free. They're actually a partner with us. We think it's so important that we have sort of a hotline for PFCU members. That phone number is here to say, you know, schedule with Clarify. You can schedule an appointment online or over the phone. They're doing everything virtually, of course, right now, but I can't recommend enough. If you are here, the next thing you should do is talk to Clarify, because they can help you not only with your credit, but they can also help you sort of create your own savings plan. All right. So let's have another little check-in, which is to say a higher credit score usually leads to what? So I put another poll up. Let me know. A higher credit score usually leads to a lower interest rate, a higher interest rate, or no impact on your interest rate. So take a look at that question, a couple more seconds. All right, a couple more seconds for the poll. Close it. All right, so a higher credit score usually leads to a lower interest rate, right? And that's why we're chasing that credit score. Okay. Had a question. I'm just checking, you know, we have a couple seconds if you want to ask a question or two about credit in the question box. Someone asking about the middle score. It is the middle. So if we're looking at the lender's going to use Experian, TransUnion, and Equifax. If Equifax is high and Experian is low, they're going to use TransUnion, not the average, but the middle. So a question about FICO scores versus credit scores. FICO score is a type of credit score, and it's the one that most lenders use. So it's the most commonly used credit score that's available. Other credit scores exist. In general, we can use them as sort of educational. You know, there's like Credit Karma that's free, that's fine, but it's not going to be the same score the lenders use. And so FICO doesn't give their score away for free because then they couldn't charge money for it. All right. Okay, so let's keep moving forward. I know there were a couple other questions, but I'm going to keep moving forward and we can potentially answer some of those questions at the end. Okay. All right, so next. All right, big deep breath. We're going to talk about money. So we're moving on to the money section. And this is where we take time to assess our spending. We're looking at thinking about what we can afford in terms of that monthly budget. So we're looking at as is, what are we actually spending currently? Not what we want to. This isn't what we could or should be spending, right? So this is the next step. We looked at credit, now we're looking at money. And money is two pieces. Money is the monthly mortgage payment, but money is also that down payment and the other upfront money you need. So let's look at the monthly payment first. So the idea here is we're not editing our budget. We're not saying this is what I can do, this is what I should do. Oh, I could definitely do this. We're looking at what are we actually doing? What are we doing right now? What have we been doing? What is our history? What is our spending pattern? And so we're looking at, you can look at your checking account, you can look at your credit card history for the last several months, whatever way that you spend money, take a look at that. You can use a spending tracker. I have one attached in the handout that you can that's useful. You can export your spending to Excel or money management. There are a lot of different financial tech apps out there, but figure out what is going to be the way that you assess your spending. I use my debit card for everything. So I take the spending right from my checking account. I write in PFCU, you can export it to Excel. I like to categorize everything myself and really get into it that way. That is how I do it. But lots of different ways, keeping receipts, writing things down, whatever makes sense for you. But it's important to sort of pick a strategy and stick with it till you get your information. So make sure to include, and I have whole webinars we can do about this, and I can link you to some that we can talk about what is our actual spending. I will be doing next week a webinar on sort of your budget and managing your money. And so if this is something you want to talk more about, come back next week. So you can register right on our website for this. Make sure when you're doing this, you include a miscellaneous category. We don't know what it is, but it might be a brake replacement for your car or a plane ticket to your friend's wedding. There's something that always is coming up that is out of the ordinary. We don't know what it's going to be. What we know, it's going to come. If you make regular savings contributions to an emergency fund or other savings goals, vacation, retirement, education, include these in your budget too. Do you support your family members? Are there seasonal costs that you have or recreational costs? Maybe you like to go camping, and so you pay for that every time of year. Maybe your child does a certain sport in a season. Think about all these things and put them into the plan. Are there gifts that you give, right? Is there charity, vacations? Plan for all of this and be realistic with yourself. Look back on several months, make sure you don't miss anything. There could be insurance payments that don't come up all the time, medical expenses, school clothes, tuition, all this fun stuff, right? Don't leave anything out. And again, on that handout, I have some tools, and please come next week because we'll talk more about this to look at, what am I digging through to make sure I don't miss anything? So just to sort of reiterate, we're not saying what we can do, not yet. This is about what we are doing. Assess what I'm actually spending. Okay, so we looked at what we are doing historically, what are we doing currently, and now we're going to look at the next part. I have a clear picture of my current spending habits, so I'm going to develop a forward-looking budget. How am I going to spend my money once I buy a house? This is going to help to decide what is that target monthly home payment that you can afford. Okay, owning a home, and I have this in bold at the bottom of the slide, but it's so important, is more than just trading a rent payment for a mortgage payment. Your monthly home payment includes mortgage, principal, interest, property taxes, homeowners insurance, and any mortgage insurance, right? We talked about all these. You want to estimate expenses for electricity, gas, cable, water. If there are homeowners association fees with the condo, you want to estimate all those. You want to estimate expenses for home maintenance and improvements. This is all you now. If you need to call a plumber, you need to pay, right? So we need to put that into our monthly budget, our monthly spending plan. Think about what your plan is going to be, what your budget's going to be once you have bought your home. Decide how much are you going to be saving for emergencies and other goals. So once I have this all in place and I can sort of plan it out, now I can practice living with these adjustments. So if my rent is $1,000 and my mortgage payment's going to be $1,300, that $300 difference can go right into a savings for the next few months until I get there. Right? So I can see, can I live without that extra money? Even more than that, I'm going to need that extra money for emergencies, for home maintenance. So maybe that's another few $100s a month, right? But what I find is useful too is that you can just search and find what estimated utility costs are for the area. You can find out what people spend generally on home maintenance and improvements and sort of use those averages to estimate your own. I find it really useful because then I can say, all right, I'm going to need to put aside $200 for maintenance every month. I might not need it for 2 years, but eventually I will, and it will be there. So new homeowners are often surprised by the extra cost of owning a property. Repair costs, upkeep, improvements, upgrades. You might need more furniture because it's a bigger space. You might need appliances. When I bought a house, it did not come with a fridge or a washer and dryer. So those are pretty big ticket items that I had to plan for. There are also things that as a homeowner you might have to pay that were included in your rent before. Water, for one, very common in Philadelphia that we don't pay water as renters, but we do as homeowners. Trash pickup, any other utilities. Thinking about other things that cost, maybe your commute is farther. Maybe you have to pay for parking where you are now. Are there utility setup fees? There are. What other things? Buying appliances. There are plenty of other things too that might come up. So it's just a great time to sort of take a look at those and start to plan for them. Okay, so this is some more tough news, but know that there are options. So okay, we're going to look at, I have a video, I'm deciding when I'm going to show it. Let's look at it now. I'm going to share this video. And this is about down payment. So let's take a minute. You should be able to see it. It should have audio in a second. Okay, so just a little information about the down payment and how it impacts other costs you have, and how important it is in deciding all of this. So looking here again at this, this invented home, now that you have a good sense of what you can comfortably afford in a monthly basis, we're going to look at the savings to determine how much you can afford for a down payment. So we took that, okay, monthly, and a lot of us, from the poll at the beginning, we said, yeah, I'm good monthly. I can figure that out. That's great. And I want to remind you again, I think I hinted at it before, but that monthly payment is going to be completely relevant based on your family situation. For example, I have 2 small children, and daycare is a tremendous amount of money. So if I'm paying for daycare, then my mortgage is going to need to be lower. It's just what it is. It's costing me $2,000 a month for daycare, so I need to factor that into my plan. So, everybody's situation is going to be a little different. Right. So now let's look at these the overall cost, right? The purchase. So we're going to look at the total funds you have available, or we're going to look at, all right, what do I want to have? What's the goal? And now this, this looks, I'm not going to lie, it looks like it is so much money, right? But there is some wiggle room, and we can talk about where the wiggle room is and then some additional supports. So last time I did this webinar, people were really interested in the additional support. So I'll make sure to give those some time today. But let's look at what this looks like. So we've got moving costs, and that's really, I just took sort of a low average. And then we're looking at renovations and furniture, and this is something that absolutely you can spend way more or way less on, depending on where you shop and what you need and what you have. Emergency cushion. So the recommendation for an emergency cushion of just in case money, rainy day money, is between 3 to 6 months, at least 3 to 6 months of monthly expenses. And so in this case, I used that median income, which is the median income for, actually, I used about $55,000. So we're looking at that emergency cushion for about $55,000 a year for that household income. Looking at closing costs. So closing costs are 3 to 5% of the purchase price. And so in this case, I used, right in the middle, and we're looking at $7,000. And then that down payment. And again, I'm going to say, let's try for that 5% in this scenario. So what is the total goal? Let's talk about closing costs too. Closing costs are all the costs you pay at closing, and that's when you sign the paperwork and get the keys. It includes some of the fees. That includes origination charges, appraisal fees, credit report costs, title insurance fees, and any other fees required by your lender or paid as part of the real estate mortgage transaction. Lenders are required to provide a summary of these costs to you in the loan estimate. So you will have those ahead of time to know how much money to bring to the table. And you're looking at then, the money you have, you need to make sure you have that money for closing costs. And whatever's left over, right, is your down payment. So this is just one way to look at it, right? But we talked about that down payment and why you might want more, because in general, the higher your down payment, right, like the video, the less your loan is likely to cost monthly and the less it's going to cost overall. Lenders decide the interest rate and the loan costs to offer you. They look at your down payment in increments of 5%. So this is really interesting. They're going to look at, are you putting down 5% or 10% or 15% or 20% generally? So they're not looking at that sort of almost, right? If, for example, you have enough saved for a down payment of 8%, think about whether you save a little more before buying so you can hit that 10% mark, or choose a slightly less expensive home so you can hit that 10% mark. Or, if you say, all right, I'll go down to 5% then and put that other cash aside for emergency, that's another good option too. So if you're unsure what to do, the best thing you can do is see a HUD certified housing counselor like someone at Clarify. There are special programs that offer low or no down payment programs. So let's talk about these a little bit. There are programs for veterans and service members, for people who are living and buying a home in a rural area. There are some first-time home buyer programs. Housing counselor is going to be a really good resource to connect you for any programs like that that exist. So again, that Clarify counselor is going to say, oh, I know that this program exists. Here's where you can get this free money. I had that experience myself. I saw a HUD certified housing counselor and they helped me connect with some money. So that's a great resource for that too. Low down payment options though, sometimes come with an increased cost. So ask your lender about choices and see different options. So I'm going to mention two, and I have two resources. One program that can help with closing costs is the First Front Door program. So this is a program, PFCU participates in it, and it is a matched program. You bring a certain amount of money to the table and they will match that up to $5,000 for closing costs. So free money, you do have to have certain income to qualify, but it's an awesome program. It is currently open right now. However, the money eventually runs out. But I will say this time of year, usually in April, this is when the money comes. So if you're not ready this year, right now, you have to be ready like right now to take advantage of it. Think about that next year. And it might be worth sort of lining up what you're doing. I would, again, refer you to a housing counselor to say like, oh, it'd be a really good time. Let me think about looking for a house at the time that First Front Door is around. So that's a good option. You can check it on our website. I do have a link to that too in your handout. Another program that can help you with closing costs is called an individual development account. And locally, there are a few nonprofits that have these. And again, you will find resources for these in the handout. But an IDA, or an individual development account, is another matched savings program. So with these programs, usually they're at a minimum of 6 months that you're in the program, saving every month. That savings then is matched by the IDA program, and that money can be used. So again, you save $1,000, you might get another additional $2,000 from that program. So where do you find an IDA locally? Clarify, are you surprised? Clarify is a great resource for that. SEBA is another organization that has it, and these are both under the United Way's IDA program. So these are excellent programs. A third resource for an IDA is the Women's Opportunity Resource Center, or WORK. These are all great resources that it's absolutely worth looking into to see, can you get some of this free money? So those are really great resources. A lot of times with it comes some education, which is always a good thing. So those are a couple of examples. Check out those resources, schedule an appointment, make a phone call, and get started. It's a great sort of way to get that free money. When you're thinking about how much money to put down, keep in mind that once you put the money into your home, it's not easy to get it out again. If you need the money for another major expense, like paying for college or medical expenses, you may find that there's no way to access this money, right? Once it's in there, it's in there. While home equity loans and lines of credit allow homeowners to borrow against their equity, you usually need to have owned your home for several years and built up significant equity in order to qualify. So it's not, automatic that you can borrow out of the equity of your home. Borrowing against your equity also isn't free. You're paying interest on that money. So I say this to remind you to give yourself a cushion. Give yourself a cushion, make sure you have some cash. And when I say cash, I mean money in an account. I don't mean physically cash. And don't forget, be careful not to wipe out all of your other savings. because then you're going to be in a bad place in other ways, right? If you wipe out your retirement, if you wipe out other savings for goals, things like that. Which is all to say, just, you know, take your time and do it when you're ready. So let's look at considering whether it is the right time to buy. And right now it is a seller's market. And I'm not here to talk about the real estate market. However, it is a factor, because your decision that you make any point along this way isn't final until you buy the house. At each step in the process, you're making a decision to say, keep going or slow down, right? And wait for a better time. Currently, a lot of buyers are offering over the asking price of the house. People are willing to buy a home without an inspection, which to me is bananas, right? Imagine the risk involved. You're buying a house for more than they're asking, and you said you'll take it sight unseen, essentially, right? You don't know what's in the wiring, you don't know what's in the plumbing. So inspections are really good protections for the homeowners, right? So people are really buying houses kind of like mad right now. So, you know, keep that in mind when we're thinking about, is this the right time? If what you can afford to pay for a home isn't enough to get you the type of home you want in a neighborhood you enjoy, you may want to consider, you know, you have some options. You can cut back on monthly spending, right? So you can afford a higher monthly payment. You can also wait to buy until you have a bigger down payment. That might allow you to buy a different home, right? You can consider, you know, renting in or near the neighborhood you're interested in. You can wait for that better credit score. If you're currently renting or moving to a new area, there is a calculator that I have attached to the handout that will sort of look at options. Is it better to rent or better to buy? And it can help you assess the trade-offs of renting versus buying based on your financial situation and the length of time you expect to be in your new home. So I would check out that calculator, see if you find it informational. I thought it was interesting. But remember that calculators are making assumptions about future economic conditions, right? So how much is the house price gonna grow, right? So they're guessing some of these things. When I changed the house price, the home price growth rate, there were significant changes in what that looked like, whether I should rent or buy. So home ownership, you know, this is like, we're weighing the pros and cons here. Home ownership can be rewarding, a great way to build wealth, but there are risks and responsibilities associated with owning property. When you buy, those risks and responsibilities are yours. For example, your home value could decline, especially right now with the cost of homes. You could lose equity or owe more than your home is worth. And this happened before the housing crisis in 2008. Is that people had these enormous loans and the home value was far less, right? So this is something that can happen. If something important breaks, like the furnace, the roof starts to leak, you have to pay for those, right? And you do have to get it fixed, you know, right away if you live there. There are certain things that your homeowner's insurance will require to be in working order in order to insure your property. If something else breaks, for example, a cracked window, a broken dishwasher, a clogged toilet, you're going to need to either spend your time or your money to pay for it. In some situations, it may be better to rent. Is your current employment short-term or unstable? Owning a home is a big financial commitment. And if you're not confident that you can continue earning a similar income for the foreseeable future, it can make sense to keep renting. Another factor, are you going to move in the next few years? Renters have more flexibility. It can be risky and expensive to buy if you end up needing to move again with a few years. You pay real estate agent commissions, taxes, other transaction costs to sell your home and buy a new one. if prices decline, you might not be able to sell your home at all if you plan to leave in the next couple of years. So a lot of things to think about, a lot of things to consider. Obviously, a lot of us have that goal, and it's a beautiful goal, right? Owning a home is great for a lot of reasons, but it's really important before you make that big decision to look at all of these different factors. So, launching a poll, we need a breather. What is more important to you? A bigger home with a larger mortgage or more financial flexibility? So, take a minute, and this is completely personal, but answer for yourself. What's more important to you? There is not a right answer to this. A bigger home with a larger mortgage or more financial flexibility? Don't overthink it. A couple more seconds. All right. Ending the poll. Here we go. So there's always a few people who said bigger home with larger mortgage. Great, right? That's great. Because that's what's important to you. However, in this case, many people thought that more financial flexibility was more important. So whichever your answer is, you want to keep this in mind at all times, because it's very easy to get swept into a bigger mortgage. Very easy to, you see that house and you check it out and it's your dream home, right? But it doesn't leave you with that financial flexibility. So it's really important to come back to this and decide where your priorities are, whichever is you, right? And figure that out. And maybe somewhere in between. But it's a great idea, and it's really easy to see friends and things like that and get caught up. But just remember, I want to, oh wait, I do want to save for my kids' college. Oh wait, I do want to go on vacation sometimes. So keep that in mind as you're planning this. So just, a couple, this is sort of the last step in this conversation that we're having today in building a network of advisors. So look to people you know, because this is complicated and it helps to have people you can talk things over with. Usually we do best when we can sort of rely on a network of trusted advisors. Not just one person, but a couple of people that we can ask questions of. Friends, relatives, coworkers can serve as advisors in this process. It doesn't have to be a professional, right? You're not getting professional advice, just sort of collecting information. So how do you do this? Start to make a list of friends, families, coworkers, and other people you trust who have bought a home or refinanced a mortgage lately. Identify about 3 people that you feel comfortable talking to about the home buying and mortgage shopping process. Because like anything, the more we connect with other people, the more we talk to them about it. Like I said, I had never heard of PMI, and I was working as a financial educator for a couple of years when I bought my house. So it helps to talk with people and to get their advice, or just hear about their experiences. It doesn't have to be someone you're super close to, and I'm not saying you have to share all your personal information, but ask them about, were there things during the process that surprised you, that you were not expecting? What did you learn through the process that you wish you knew at the beginning? If you were buying and financing a house again, what would you do differently? And these are great questions. Your HUD certified housing counselor that you connect with through Clarify could be a great resource for this. If Clarify is not the right fit for you, I have a link to a database of HUD certified housing counselors. And I really recommend Clarify, but there are so many excellent organizations, a lot of the CDCs in local neighborhoods are HUD certified housing counselors. Depending on where you are in the city, you might find one is a really good fit for you. I know like there's one in West Philly that serves communities in West Philly. There's some all over the city, so you can check out finding that housing counselor. Maybe it would really, you'd feel best going to one in your neighborhood, and that's great. So check out that link in your handout. It's not just talking to real estate agents and mortgage loan officers. They're important sources of information, but they're not the only people you should consult, because they make money based on your decisions, right? Their interests their interests may not always be aligned with your interests. So always ask yourself, does what I'm hearing make sense? Having a network of advisor helps you evaluate what you're hearing and help you think through major decisions. Right. So we've talked about the credit. We've talked about your monthly payment and spending. We've talked about your down payment. We've talked about building a network of advisors. So the next step, is to work on those pieces to save your money, right? To come to my webinars about saving for goals, is to work on your credit and filing disputes. And so then here we go, looking at this checklist again, we're looking at, this is sort of the checklist. And I want to ask this question too. We're not done yet, but I want to check in. Do you feel, now than an hour ago, are you a little bit better prepared to save and plan for a mortgage? This is not to say we're not buying the house today, but are you a little better prepared to save and plan? So take a minute to answer this poll. All right, a few more seconds. And if you're just completely overwhelmed, that's okay. Come to the, next week to credit, we'll break it down. Come to saving for goals, we'll break it. Oh, next week is not credit, next week is budget. But we will be talking about credit next month. All right, so I am going to close the poll. Let's look at some of these resources now, and then we can get to some questions that you have. But I'm going to show you some resources. All right, and we are not quite done, but I just want to say, if you have to leave, thank you so much for coming. Again, not done, but please, when you X out, there will be a poll. So please take a minute to answer it. It's 4 questions, it's very short. So this is, you should be able to see on your screen, I'm sharing the handout here, and this is tons of resources that we talked about. Some of the key terms that we talked about. There is a roadmap. So the plan we talked about today walked through on this, this path. Where do you find a HUD certified housing counselor? That is there as well. Okay, so you can find in your neighborhood what the best housing counselor for you is. Clarify, to schedule an appointment with Clarify for free financial counseling, free credit counseling. They are HUD certified. Either call or schedule online with them. That one of the 3 factors, we've got money, we've got credit, we've got income. If you are needing help in the income category, check out the career link. The Pennsylvania career link can help you with these career goals. Next, if you are interested in these down payment and closing cost match savings programs that I mentioned, we've got a link to information about the First Front Door program, and then IDAs with SEBA, with Clarify, and so you can find more information there, and you can also reach out to them. One additional plug for a Clarify program, they have a family self-sufficiency program, and this is something for anyone who is a resident of PHA, Philadelphia Housing Authority, or has a housing choice voucher, Section 8, you will qualify for the family self-sufficiency program through Clarify, and there are some excellent supports. And when I say supports, I mean ways that you can help yourself with money, basically, through the Family Self-Sufficiency Program. So I have a link to that program. So anybody who is in PHA or Section 8, check out Family Self-Sufficiency. I cannot recommend it enough. There are really awesome ways that they can support you in order to be closer to that home purchase process. And then those are the resources. Where do you go for help? Here are a bunch of tools. So whether it's a webinar recording on managing your debt that I did, or your credit report review checklist, spending tracker tools, you can see sort of all of these tools that I talked you through that I referenced are right here. So they're all right here, and you can take a look at those. All right, let's hop over to questions. Pablo, if you are ready, do you want to unmute with us? And
good afternoon, everyone. All right, so yeah, we have some great questions here. Can you hear me?
Yes, it's morning. I'll be quiet.
It's almost 11:30. It's brunch time, we'll say.
Okay.
But let's see here. We have some great questions. So a few times we did see questions about spouses and spouses on the application, so I'll answer those first. First and foremost, does a spouse's credit get considered by default, even if you don't put them on the application? So the lender will only look at people who are on the application. So they will not consider your spouse if you do not put them on the application. There were also some questions about what if your spouse has no credit or income? So in this situation, even though you have an excellent FICO score, you might not be approved, or you may pay a higher interest rate because of your partner's score. If you face this situation, it might make more sense to apply for a mortgage without your partner or spouse. It is possible to be added to the title deed of the house without being on the mortgage. So that's something that you can consider if it does make more sense for you. We also have questions about student loans. So when it comes to student loans, you want to look at your debt to income ratio. So to do that, you'd look at your current expenses and new expenses that you anticipate as a homeowner. You'd add all of that up and see what percentage of your income is left after you pay your bills. So generally a lender you can still qualify for a mortgage if you're at less than 36%, but I'm sure that Erin would love for me to tell you, for your own well-being, that you want to try to remain much lower than that, just so that, like she said earlier, you want to have room to be able to add things to your life, take a vacation, start saving for college or kids' college, or just expenses that come up that we don't initially plan for. Our next question is if you can be approved for multiple grants. And the answer to that is yes. You always just want to read the qualifications and the rules for that grant, but generally it's encouraged that you find all the free money that you can find. Let's see, our next question here is rental payment history a factor? So the way to look at this is if it's on your credit report, if they reported it to your credit report, then great. If they did not report it to the credit bureaus, then unfortunately, there's no way for a lender to include that into your credit score or financial history. In regard to a down payment, we do have questions about if it's okay to use a 401k. You can use the 401k funds to buy a home, either by taking a loan from the account or by withdrawing money from the account. You just have to consider if that's the best option for you and if that's something that you really want to do. And then there are questions about FHA loans and if they require PMI. And we can't get into too much detail about FHA because that is a specific program that you should reach out to the FHA or FHA rep about. They do not have PMI, but they do have something called MIP, which is mortgage insurance premium. So yeah, it's not completely gone, but for more details about that, you should probably reach out to an FHA rep.
And if I can just jump in.
Absolutely.
So one of the attendees here said that they contacted Clarify last week and was told that the IDA program is being discontinued. So WORC, Women's Opportunity Resource Center, is another place that has IDAs. So just another place. So you can Google Women's Opportunity Resource Center and see what they have to offer. They have IDAs for several different things. So thank you for that. Back to you.
I do see another good question here. Thank you very much. There is a good question here. If you can roll your closing costs into your mortgage, you cannot. You do need to pay your closing costs. And that's all the general questions that we have here. If anyone else has any more questions, please do feel free to ask in the chat or ping in. And